As you know, I'm a big proponent of using leverage ETFs to build long-term wealth and to use buy and hold strategy, despite the fact that many people out there say that leverage ETFs are not suitable for long-term investing. There is tons of research that I'm going to show you in this video why you should really use leverage ETFs. There are tons of papers, academic research, and backtesting that I myself have done over the last few years. And it's thanks to leverage ETFs that I'm now financially free, and I live in Hong Kong, and life is beautiful with leverage ETFs. But despite the fact that I've been talking a lot about 3x leverage ETFs, because historically they have been performing very well, at the moment, most of my portfolio is only 2x leverage ETFs, and my average leverage of my 3F portfolio is only 2x. And in this video, I'm going to tell you exactly why I'm deleveraging my portfolio, exactly why I don't have 3x leverage, why I'm doing only 2x leverage, and my exact strategy for the long term. I have a strategy where I use leverage to DCA the market and actually to buy the dip. So stick around, I'm going to show you some really interesting data. Hey guys, my name is Henry. I'm a hedge fund manager based in Hong Kong, and today I'm going to tell you everything you need to know about leverage and leverage ETFs and how to manage your leverage, okay? You can check my other videos. I talk a ton about leverage ETFs, how to build wealth with leverage ETFs, because if you don't use leverage ETFs, in fact, you are leaving gains on the table. This is like mathematically and statistically correct. And I love math. I'm a quantitative trader, investor, and you really need to look at the math. And people that tell you that you should not use leverage ETFs for the long term, they are not looking at the math, because if they understood a little bit of math, they would use leverage ETFs. Okay, guys, the first thing I want to share with you is this paper here that you can see on the screen, Alpha Generation Risk Smoothing Using Managed Volatility. This is a paper by Tony Cooper from 2010. It's already a few years old, but what I actually want to share with you is that Tony Cooper in this paper backtested over 100 years of data. In this chart here, what you see is the US stock market from 1885 to 2009. And if you actually have used for this over 100 years period a 2x leverage in the US stock market, you'll perform better than just using 1x leverage. If you used more than 2x leverage, then you'll have diminishing returns, because too much leverage will increase the volatility quadratically. It will increase the volatility too much, and you have the so-called volatility decay. But there is an optimal point of leverage that you can use. And for the last 100-something years in the US stock market, that optimal leverage will have been a 2x leverage. And you need to have into account that this data analyzing the stock market from 1885 to 2009 includes the Great Depression, includes many different crashes, the 1987 crash, includes the financial crisis, includes the dot-com crash, includes tons of stuff that happen in the market, right? And still, the optimal leverage will be 2x. Another chart that I want to share with you from this specific paper is this one, on the left specifically. For the S&P 500 since 1950 until 2009, the optimal leverage would have been a 3x leverage. So for this period, which is 60 years in the market, if you have used a 3x leverage, you will get optimal returns. You will maximize returns. More than 3x, too much leverage, you have too much volatility. Less than 3x, you're actually leaving gains on the table. But this doesn't mean that you should blindly use 3x leverage. So this is why I'm always talking about different strategies to invest in leverage ETFs. Because if you are investing now with a 3x leverage and tomorrow there is a crash, you are a bit screwed, right? You don't want to be using a 3x leverage ETF when there is a crash, when there is a bear market. And this is what I teach in my Henry Wealth Academy, okay? I have a 5-hour-long course, okay? I've been telling people it's like 4.5 hours long. It's actually 5 hours long talking about leverage ETFs. I talk about leverage ETFs every single day in my Henry Wealth Academy. Check the link in the description, because you can have a 7-day free trial. You can cancel it anytime, no questions asked, and you can get the proper data to invest in leverage ETFs and the proper education. And one of the things that I share in the community is an indicator that I created. This is the Kelly Criterion curve. And the Kelly Criterion basically tells you what's the optimal leverage that you should use for long-term returns to maximize your wealth in the long term. And the chart that you can see here, I have applied my Kelly Criterion, which I teach how to use, by the way, and it's available on my community. I apply it to VOO, the S&P 500 ETF. And as you can see here, it says the Kelly optimal is 4.4. So 4.4 leverage on VOO, on the S&P 500, will be pretty aggressive, right? And that's why most of the people use half Kelly. So these half Kelly, at the moment, it shows here 2.2. The optimal sizing will be something between 1.5 and close to 3, as you can see here on the chart. And this is the kind of leverage that I'm looking for. The market, at the moment, the markets are hitting new all-time highs. You know, over the last, fun fact, over the last 10 years, do you know how many times we had all-time highs in the S&P 500? 310 new all-time highs. But it feels that the market at the moment is kind of hot, because actually, if you look at the S&P 500, since the last day of March until now, is up 18%. 18% is usually the returns of the S&P 500 over almost 2 years, right? The average return of the S&P 500 is like 10% a year. So if it goes up by 18% in such short period, I tend to deleverage. So at the moment, on the S&P 500, I'm using a 2x leverage. And to achieve 2x leverage on the S&P 500, you can either use an ETF such as SSO, or you can use UPRO, which is 3x leverage, but you put 2/3 of your cash into UPRO and 1/3 in sitting in cash. And basically the average will be 2x leverage, right? Smart. And the reason why I like to use this so-called half Kelly, not a full Kelly, is that half Kelly will give you 75% of the returns of the Kelly curve with half volatility. So half Kelly is usually a better way to go, especially if we are a bit more conservative investor. But I'm going to show you in this video, okay? I'm going to show you that sometimes I actually go full Kelly. I go full 3x leverage, but only in very special circumstances. Okay, let's look at the QQQ. QQQ, also Kelly optimal, 396. 396 is pretty aggressive. So the half Kelly will be actually 2x, and 2x or 1.98, which is the same here on my indicator. This will be an ETF such as QLD or a mix of TQQQ and cash. You can also do that. What else? IWM. IWM is the Russell 2000. And the Russell 2000 has been a little bit more volatile. So as you can see here, the Kelly optimal will be 2 and the half Kelly will be 1. So we actually, given the volatility of this ETF, you can eventually just not use leverage. For a period, I was actually using also TNA. TNA is the leverage version for Russell 2000. At this precise moment, I don't have TNA because I had another way of investing in not be so concentrated in the Max 7, you know, those big companies that have too much weight on the S&P 500 and the Nasdaq 100. And the way I did it is to invest in RSP. So RSP is actually, at the moment, one of my favorite ETFs, and URSP is the 2x leverage version. RSP is basically the equally weighted S&P 500, because the S&P 500 at the moment is very concentrated on the big companies, right? You have Nvidia, Amazon, Tesla, Apple. These companies have a large weight on the S&P 500, too much concentration. So if you are concerned with that concentration, RSP, the equally weighted S&P 500, gives the same weight to exactly every company in the S&P 500, and because it's 500 companies, each company will have a weight of 0.2, okay? So this is optimal actually to give you downside protection, because if tomorrow there is a crash, historically, RSP goes down less than the regular S&P. And for that reason, I'm doing now the 2x leverage, which is URSP. As you can see here, the Kelly optimal will be close to 4. I'm doing the 2x. And half Kelly here shows 1.69, so I'm doing actually 2x leverage ETF on the equally weighted S&P 500. Finally, another one that I want to share with you is Berkshire Hathaway. So what's going on, Henry? Like the other day, you told me that you should not do individual stock leverage ETFs, and now you're investing in individual stock leverage ETFs. That's it. That's right. I'm doing it because Berkshire Hathaway is actually a holding company, and they hold many stocks in. It's basically, it's almost like an ETF, you know. Berkshire Hathaway, legendary Warren Buffett, he's already retired. He retired last year. And now Greg Abel, who is a great manager, is managing Berkshire Hathaway. And they are sitting in $300 billion of cash. They have been underperforming, but I believe that, again, this will be great downside protection in case there is a market downturn or a crash. So I like to have a portfolio where I have a very aggressive side, okay? I have these leverage ETFs, but I'm also leveraging like protection. And leveraging protection for me is investing in equally weighted S&P 500, is investing in Berkshire Hathaway. This is like super conservative, but I'm adding like a 2x leverage to the conservative of this portfolio. And then I also have some treasury bonds like TMF, TLT. Anyway, back to the chart. What we can see here is that Berkshire Hathaway, Kelly Optimal 3.3, half Kelly 1.6. So I'm doing the 2x leverage for Berkshire Hathaway. So guys, and let me tell you about the strategy that I use leverage and why I don't use the constant leverage. I don't stick to 3x or 2x leverage like those academic papers shows us. Of course, maybe if you close your eyes and if you have a very long term, you can blindly do 2x leverage, but you can improve your returns and improve also your level of volatility, having less volatility. You can improve your Sharpe ratio, which is the so-called risk-adjusted returns if you are a geek, financial geek, by decreasing leverage on the way up and increasing leverage on the way down. So as you can see here on the screen, I call it the counter-cyclical leverage. So when the markets are going up and they are getting hot, you know, markets don't go up forever. And the more they go up, the less leverage you should use. So on the way up, I usually start selling 3x leverage ETFs, and I put into 2x leverage ETFs, or I put into 1x leverage ETF. So as it goes up, I go from 3x leverage to 2.5 to 2x leverage. At the moment, I'm at 2x leverage. And if the market turns around and you have a bear market, then I start to buy the dip, I start to DCA using the leverage ETFs, okay? So if my leverage at a given point at the moment is 2x and tomorrow there is a crash, I will sell my 1x or 2x leverage ETFs and buy the 3x leverage ETF. And I buy these every time the market drops by 10 or 20%, because again, it will not drop forever, right? This was a great strategy in the COVID crash. It was a great strategy during the 2022 market downturn. It was a great strategy with the Trump tariffs crash in 2025. It was a great strategy in this year because of the Iran conflict. If you bought a dip by using a little bit of leverage ETFs, by going from 1x to 2x or from 2x to 3x leverage ETFs, you do awesomely. It's really, really good. And this is basically how my leverage ETF portfolio over the last 1 year alone returned over 60% compound annual growth rates. And I've been achieving these kind of returns over the last, I started investing in leverage ETFs like 6 or 7 years ago. So basically, this is how you do it. And in my community, in my course, I explain exactly the levels you should buy or sell your leverage ETFs in order to rotate a little bit more conservative or to increase your aggressiveness in terms of leverage. There are different levels, different percentages that you can use to increase and decrease your leverage in order to maximize your returns over the long term, in order to lower the volatility of our portfolio, and in order to retire early, because at the end, we are doing this because we want to achieve financial freedom. Okay, guys, if you like this kind of stuff, please check the Henry Qualls Academy 7-day free trial, no questions asked if you cancel. And if in these 7 days you can take the courses, you can cancel, and it's all good. And if you like this kind of video, I'm always talking about building wealth with like proven strategies. If you like this content, give it a like and subscribe to content, because really I'm giving away like $1 million strategies here. Okay, I hope you have enjoyed, and I'll see you next time. Bye.